You know what's interesting about flying commercial jets? The fuel gauges don't lie. You can have the prettiest flight plan in the world, perfect routing, favorable winds, smooth cruise altitude, but if the fuel numbers don't match the flight plan, none of it matters. The gauges tell you the truth, whether you like it or not. Free cash flow is the fuel gauges for a business. This is Captain Pierce. Welcome back to Skies Capital. Think clearly, invest better. Today is day 2 of a 30 days series. We're going to be talking about free cash flow, what it actually is, why it matters more than most investors realize, and what to watch for when you're reviewing it, how to spot the red flags and the green lights. If you've ever looked at a company's earnings, felt good about those numbers, and then wondered why the stock kept disappointing, I know I have, this video is for you. Let's go. Let's start with the basics. Free cash flow has a simple formula. You take operating cash flow, that's the cash the business actually generates from running its operation, and then you subtract capital expenditures. That's the money the company has to spend to maintain and grow its assets. Things like equipment, facilities, technology, infrastructure. And here is the key phrase: cash left after keeping the lights on. I like to think about this like this. Imagine you're the pilot and you've just completed your assigned flight. You burned the fuel you needed to fly the route safely. You land, now you check your fuel gauges and how much fuel is actually left over. That's your free cash flow. That's what you have available to do something else with. You could fly another leg. You could save that for a longer leg down the road. The point is, it's real. It's not projected. It's not an accounting entry. It actually exists. Now, contrast that with earnings. Reported earnings are important, but they include a lot of things that are not actually cash. Depreciation adjustments, revenues that have been recognized but not yet collected. You have a company reporting strong earnings for years, while the actual cash flow generation tells you a completely different story. Free cash flow cuts through all the noise. So why does this matter? Let me give you 4 reasons. First, earnings quality. When a company consistently converts its earnings into free cash flow, that's a signal that the profits are real. It means the customers are paying. It means the business model actually works on a cash base, not just paper. When there is a big gap between reported earnings and free cash flow, when earnings are growing but cash flow is flat or falling, that's worth paying close attention to. It doesn't automatically mean fraud or manipulation, but it does mean that you need to understand what's causing that gap. Second, dividend safety. This is especially important if you're an income investor like me. A dividend that is being paid out of a strong, durable free cash flow is one you can feel reasonably confident about. A dividend that is being funded by debt, asset sales, financial engineering, that one has a much shorter runway. Before I own any dividend stock, I want to know the free cash flow coverage, not just the payout ratio based on earnings. The actual free cash flow versus what those dividends cost. Third, valuation. When you're assessing what you're paying for this business, price to free cash flow is often more honest number than price to earnings. It asks, what am I actually paying for real cash that this business is generating? A company might look reasonable priced on PE basis and expensive on a price to cash flow basis. The difference is worth understanding. 4, business resilience. Companies that generate strong free cash flow through economic downturns, not just during good years, tend to be structurally strong businesses. They don't need to borrow to survive in rough patches. They don't need to dilute their shareholders. They have options. In aviation, we talk about options a lot. Having extra fuel gives me options. Having many more diversion airports gives me many more options. Free cash flow gives businesses options, and options are worth a lot when conditions deteriorate. All right, let's get practical. When you're actually sitting down to review a company's free cash flow, here are 4 things I like to look at. Number 1, is free cash flow trending in the right direction? Remember, the trend is your friend. This is the most basic question. Is it growing over time, shrinking, volatile quarter to quarter? A single quarter does not tell you much. What you're looking for is a multi-year trend. A business that has been steadily growing its free cash flow over 5, 10 years, even though it has some bumpy periods, it's still telling you something important about the durability of the underlying model. Number 2, how does free cash flow compare to reported earnings? I pull up both numbers and look at the relationship. Ideally, you want free cash flow to be tracking close to, or better yet, exceeding net income over time. When free cash flow consistently runs well below earnings, I want to know why. Is it higher capital expenditures, raising receivables, something else? The gap isn't always bad. Some businesses are investing heavily in growth, and the capex is genuinely productive. But you want to understand the story, not just accept the headline earnings numbers. Number 3, capital expenditures get deducted to arrive at free cash flow. So naturally, a business in a heavy investment phase will show lower free cash flow. That's not always bad, but it's worth separating maintenance capex, the spending required just to keep the business running at its current level, from growth capex, spending on new capacity, new markets, new capabilities. Maintenance capex is essentially a cost of staying in business. Growth at capex, if well developed, should generate future returns. If the company is spending a lot on capex, but you can't see evidence that is generating better returns or growth over time, that's a red flag. Number 4, is free cash flow covering capital return program? Dividends, buybacks, and debt reduction. These are all funded by free cash flow. I want to see free cash flow comfortably covering what the company is committed to returning to its shareholders, with a cushion left over. If free cash flow is barely covering the dividend, the margin of error is thin. If operational conditions weaken, or even just temporarily, management may be forced to cut the dividend. That's a painful outcome for income investors like me, and the market usually punishes it severely. Red flags. Now let's talk about what raises my concern levels. These are the warning signs I watch for. Red flag number 1, earnings growing, but free cash flow keeps declining. I've seen this pattern in companies that are aggressively recognizing revenues, loosening credit terms, or making accounting adjustments that flatter the income statement without actually generating more cash. GE is one of the most studied examples of this. For years, earnings were solid, yet the cash flow was quietly telling a different story. And when the gap finally closed, it didn't close well for the shareholders. Over time, this gap tends to resolve itself and usually does not resolve in a way shareholders enjoy. Red flag number 2, a dividend being paid despite negative or deteriorating cash flow. I'll be direct about this one. A dividend funded by borrowing assets or drawing down cash reserves is not a sustainable dividend. Management may defend this aggressively, but they essentially are mortgaging the future to pay today's income. In flight terms, it's like a crew deciding to extend their route even though the fuel gauges are in the reserve territory. You can do it for a little while, but eventually the math catches up. Red flag number 3, CapEx expenditures jumping sharply without a clear strategic explanation deserves scrutiny. Sometimes it's legitimate. A company building out a new facility, upgrading systems, making investments that will pay off. But sometimes it's a sign of poor capital discipline, an overambitious management team, or worse. Always ask, what is this spending designed to produce? And when should we expect to see a return? Red flag number 4, free cash flow always just around the corner. Everyone has heard the story before. The company is investing heavily today, but management is promising free cash flow generation is just a few years away. At some point, just around the corner starts to sound like the flight's never going to actually depart. Some businesses generally need a longer lead time to generate cash. But if a company has been promising future cash flow for many years without it delivering, and the explanation keeps shifting, that deserves a much higher level of skepticism. Now, on the other side, what does a strong free cash flow actually look like? Here's what gets my attention in a good way. Signal number 1, Free cash flow consistently exceeds reported earnings. When a business converts 100% of its net income in free cash flow over time, that is a very positive indicator. It usually means the business model is capital light, working capital is being managed well, the earning quality is high. You're getting more cash than the income statement alone suggests. Signal number 2, free cash flow growing faster than revenues. This is a signal of operating leverage and improving margins shown up in the real cash, not just accounting figures. It means the business is getting more efficient as it grows. Quality compounders at work. Signal number 3, managing reinvests free cash flow with discipline. Great free cash flow generation is only half the equation. The other half is what management does with it. Are they buying back stock at a sensible price? Are they growing the dividend at a rate supported by the cash flow? Are they deploying capital into acquisitions that make strategic sense, or the empire building for their own sake? Capital allocation is where great businesses either compound value over time or quietly destroy it. Free cash flow gives management the fuel to allocate. How they use it tells you a lot about the quality of management. Signal number 4, free cash flow holds up through downturns. This is the real test of the business quality. It's relatively easy to generate decent cash flow in strong economic environments. The business that can continue to generate meaningful cash flow during recessions, industry downturns, or periods of extreme shock, those are the ones worth paying a premium for. Think of it like flying through rough air. Some aircraft handle the turbulence smoothly, others shake apart. You want to own an aircraft, the business, that holds its altitude through rough patches. Let's bring it all together. Earnings tell the story. Free cash flow tells the truth. That doesn't mean the reported earnings are meaningless. They matter, but free cash flow is one of the most honest signals available to a long-term investor like me. It's hard to manipulate that earnings. It connects directly to the dividends, the buybacks, and the debt management, and it tells you whether the business model actually works on a cash basis. Before you trust earnings reports on face value, check the cash flow statement. Look for trend. Look for the relationship between earnings and cash. Look at what CapEx is doing, and ask whether the capital return program is actually supported by the cash that the business generates. A business that earns well on paper but generates little real cash is flying on borrowed time. It requires a lot more scrutiny before you buy that ticket. This has been Captain Pierce with SkiesCapital. Think clearly, invest better. If you found this useful, best thing you can do is to share it with someone who's learning to invest. If you have any questions, drop them in the comments. I'll read every one of them. I'll see you on day 3.